Beware of false knowledge, as it is more dangerous than ignorance. Today I want to talk about mortgage fee estimates and the closing disclosures, the most important pillars of your mortgage loan terms. So, lot of savvy professionals who've been very successful in their respective careers always stumble upon when it comes to the loan estimate and also the closing disclosure to see at the numbers. In this video, I want to explain to you in very simple terms how to break down this complicated yet very critical document so that you make sure that you understand what you're getting into when you're signing up for a mortgage. So on the screen you see this document called closing disclosure. It's a 5-page form that provides final details about the loan that you've selected. Not only does it include the loan terms, your projected monthly payment, but also it includes all the other closing costs that are associated with you getting a loan. So you get a similar copy of what you see on the screen when you are signing up for a loan, which is the loan estimate, and just before you close, 3 days prior to you closing. Closing disclosure has multiple sections that are named with the alphabets A, B, C, D, and so on. You need to pay attention to the loan amount. The loan amount that you see on your mortgage statement might not be the one that is being paid off, because you also have interest from the time that you have your mortgage statement printed to the time the loan actually closes. There will be more interest accrued. So what you see in the loan amount will never be the same identical one that you're going to be financing. So when you look at the cash to close, it will be higher even though you're going for a zero cost loan, because there is not only the interest that is being charged on top of what the bare minimum loan amount is, and also there is other charges. So when I go to the next page, I want to show you a few important things. Let's say you are doing a zero cost loan. The first thing that I would jump to is the section J, wherein it talks about the lender credits. So lender credits, in this case, the lender is providing $4,640.90 as a credit for just initiating the loan. So that is coming as a credit, and then you jump to the section D, that is the total loan cost, which is, again, I want to focus on two tabs. One is the loan cost tab, that's where we are, and then the total loan cost is what is shown in section D here. So that is the total cost, and this is an example of a zero cost loan. I mean, it's short by a few $100s, but it is very close to what a zero cost loan is. And in this case, this CD will be adjusted so that the total loan cost that you see in section D will be equal to what you see in the lender cost. So if they are same, but still there is cash to close. There is cash to close even though it's a zero cost loan. The reason for that is there are multiple things that are happening. Now we want to go to the tab that says other costs. The other costs are the ones wherein you have EFG. One is just the recording fee for the county, plus you have prepaids. Prepaids are the ones that your new lender would like you to pay for. So there is some interest, and also there is insurance premium, and also property taxes. They calculate and put it here in this section. If you have an escrow balance from your current lender, all that will have to be pre-funded. So what you see in section G, the 2358 right now, these are the escrow balance that you have with the current lender, which you will get a refund. So all this will be added, and that's where, if I go to the previous screen, you see cash to close. So a zero cost loan will still have cash to close unless you choose to add that to the loan amount. Let's say you don't want to come up with 4,500. You will get a refund from your current mortgage lender with some of this, which could be your escrow balance, and some of it will be excess paid principal or interest, because you will be making probably another payment before that. And most importantly, you will be skipping a month's payment. Let's say your refinance is happening in June, your next payment will not be until August 1st. So this cash will include all of that. So the biggest message is, if even if you're doing a zero cost loan, there will be some cash to close and you better have some reserves for that. So let me pull up another example. In this example, what I want to show is similar, wherein you have the loan amount. Again, this will not be the same. Then you have about 5,900 cash to close for this. The main thing that you want to focus on is make sure the interest rate is correct and the projected monthly payment is correct. And then there is an additional one here. They also include the homeowners association dues. They also add it here so that you'll see a difference between what is the difference between with HOA and without HOA. So again, going back to the page 2, what are we focusing on? We are focusing on two things. One is the loan cost tab. The second thing is the other cost tab. So the other cost has nothing to do with the loan. So whatever you see, let's say you see 3308 for the initial escrow payment, that is your cost. Even though it's a zero cost loan, that is your cost. Then your prepaid interest, that is your cost regardless of the loan. Same with the taxes and government fee. So in this case, I want to again grab the attention to the lender credits. What you see in the lender credits is something that you as a borrower are getting, and then jumping back to the section D, that is what you are spending. So this is close to a zero closing cost loan. So in some cases, I've also seen wherein if the credits are too much, the lenders also chose to give it as a principal reduction. So in this page 3, you see principal reduction, excess rate credit. If there is a lot of credit left over, you also get interest rate credit. So when you're trying to analyze this this closing disclosure, you need to look at three main aspects. You need to look at your total cost, which is in section D. You need to look at your lender credits, which is this, and then the difference of that is actual transaction cost. Then you also have to pay attention to E, F, G, and H, which is going to bring your cash to close up. Then you go to page number 3, also pay attention to the principal reduction. So that's what you want to do. This is for refinancing. Let's say if you're purchasing a house. So when you're purchasing a house, things are slightly different, but the format is very similar. In this case, you'll have similar A, B, C, and D and the same formula, but the only difference is the transactional cost. Even though here it says loan cost for purchase, you still have your title fees, which are in section B and C. Those cannot be counted necessarily as loan costs. They are part of your loan, but they are all related to your title because they are all going to other vendors like American Title. In this case, there is a notary signature, then there is a bundle fee, whatever the settlement fee. So all this is we just call it like third party junk fees, because all this has nothing to do with your loan, and all of these cannot be counted as your loan cost when you are comparing different loan companies. What you are looking at is section A is what you have to see, and then you have to jump down all the way and then see the lender credits. What lender credit are they providing? So in this case, I see that there is some lender credit, and then lender is paying for all of these. That means all these are being covered by the lender. So when you're buying a new home, still the best way to read it is first jump all the way down and see if there is any lender credit. Then you, from there, you jump back to step number 1. Step number 1 to see how much the actual loan cost is. So that's how you do it. You jump all the way down, look at the lender credit, and jump back in and see what you have in section 8. If you want super transparent and honest answers and just a neutral opinion on any closing disclosure, feel free to reach out to us. We'll be happy to win your trust. Thank you.